Good morning, everyone. My name is Prateek, and today I'll be teaching you economics. The topic that we have taken up for discussion today is the computation of national income or computation of income of a country. Now, when we talk about income of a country, there are 8 different metrics that can be used in order to measure it. Those metrics are gross domestic product at factor cost, gross domestic product at market price, net national product at factor cost, net national product at market price, and 4 other metrics apart from that, which are not that significant for us. Now, any of these metrics can be measured or it can be calculated by the help of these 3 different methods that I'm going to enumerate. The first method is the value addition method. The next one is the income method. And finally, we have got the expenditure method. By using these methods, you can compute the value of the income of a country. All right. Now, before we dive into the details of these methods, we are first of all going to have a look. We are first of all going to have a look at some very important concepts that are required in order to understand this chapter. And I'm calling it a brief revision of some important concepts because you have already studied these concepts in the preceding chapter. All right, the preceding chapter being the different measures of national income. All right, but we are still going to have a revision of them so that you don't encounter any hiccups while studying this chapter. So the first thing that we need to revise is what exactly is national income. Now I told you when we are talking about the income of a country, it can be measured in 8 different methods. But when I'm talking about national income, there is just one metric that we need to be talking about. It is net national product at factor cost, NNP at FC. It is defined as the net value of all the goods and services that are produced by the nationals of the country at factor cost. If you notice carefully, there are 3 words that I have underlined in this definition, namely net, nationals, and factor cost. Net, national, and factor cost. I have underlined them because these are the parameters which distinguish this metric from the 7 different metrics. All right. And we are going to have a discussion of these 3 parameters one by one. Let's start off with the difference between net and gross. In order to understand that, let's take an example. Let us say that you have a car which has been produced by a manufacturer for a price of 1 crore rupees or 100 lakh rupees. He sends it to a retailer in the hopes that the retailer is going to sell it by the end of the year. But unfortunately, the retailer is not able to do that. At the end of the year, it remains in the form of unsold inventory. All right. But this car, while it is standing for the entire year, it is bound to have some wear and tear in it, right? There might be some parts that get rusty. There might be rodent damage, as a result of which the value of the car is going to fall down. It's not going to remain the same. So in this example, I have assumed that the value of the car falls down by 15 lakh rupees. So this loss of value of 15 lakh rupees, this is called depreciation. It's a very important term. We call it depreciation. Depreciation is what distinguishes net from gross. All right. If I take the gross value and from that I subtract the depreciation, I will obtain something that is called the net value. All right. We obtain something that's called the net value. Net value is equal to value of the good, that is the gross value of the good minus the depreciation. All right. In this example, the gross value of the good was 1 crore rupees and the depreciation which happened was 15 lakh rupees. So we can say that the net value is going to be the gross value 1 crore minus the depreciation 15 lakhs, which is equal to 85 lakhs. So the net value in this case will be 85 lakhs. So if we are clear, we can move to the next topic. That is factor cost versus market price. Now this is slightly more dicey, Now what exactly is market price supposed to be? Let us say I go to a market in order to buy a pen and I pay 10 rupees for that. So that will be the market price which has been paid by me. The money that I pay for a commodity is the market price. Now out of those 10 rupees, 1 rupee is taken by the government and 9 rupees goes to the manufacturers of that pen. So the factors of production, that is the manufacturers of the pen, they are getting 9 rupees. So 9 rupees is going to be the factor cost. All right. So out of those 10 rupees, 9 rupees is going to be the factor cost and 10 rupees is going to be the market price. In order to understand it better, let's have a look at another example. The example is that a pineapple farmer sells a pineapple. He produces one pineapple and he sells it for a price of 10 rupees. All right. Now the government provides him with a subsidy of 10 rupees for that pineapple. Okay. The pineapple is acquired by the real juice company, which then sells it to you for 118 rupees. Out of these 118 rupees, 18 rupees comes out to be the GST for that commodity. So, what exactly is the factor cost and what exactly is the market price in this particular case? Let's have a look at that one by one. All right. The money which has been paid by you is the market price. The 118 rupees that you have given is the market price. Now, out of the 118 rupees that you have given, some particular amount is going to the government and the remaining amount is going to the factors of production. What are the factors of production in this case? The first factor of production is labor of the farmer. All right. And the other factor of production comes from the manufacturer. He will be putting up some capital and he will be putting up some labor as well. All right. So how much are these factors of production getting? So if I take the market price and from that I subtract how much money has been taken out of circulation by the government, I'll be getting the factor cost, right? So how much money has been taken out by the government? The government took out a tax of 18 rupees and at the same time it gave the farmer 10 rupees, right? So we can say 18 rupees was taken out and 10 rupees was given back by the government. So the government has effectively taken out 8 rupees, right? So that 8 rupees is going to be called the net indirect taxation. If I reduce it from the amount of money that I have paid, I'll get how much the factors are getting. The factors are going to get 118 rupees minus 8 rupees, that is 110 rupees. All right, let's have a look at this example once again. The government gets 18 rupees in the form of GST. It returns 10 rupees in the form of subsidy. So it is effectively taking out 8 rupees. If I subtract this 8 rupees from the 118 rupees, that is going to give me 110 rupees, which is going to come out to be the factor cost. All right. So money paid by you minus the taxes that have been taken by the government plus the subsidy which has been paid by the government, this is going to come out to be the factor cost. If you simplify it further, you will get money paid by you minus small brackets, taxes minus subsidy, bracket closed. Now this taxes minus subsidy is a technical term which is called net indirect taxes. All right. So money paid by you, that is the market price, minus net indirect taxes, that is going to come out of the factor cost. And this formula has been notified in the previous slide. Factor cost is equal to market price minus net indirect taxes. All right. Now let's have an example of how exactly national income is measured. All right. So there is a country. Actually, there are no countries like the country that I'm talking about. It's a fictional country. This country produces only two goods, good X and good Y. The final market value of good X is 15 crores and the final market value of good Y is 30 crores. The government obtains a GST of 5 crore rupees and it pays a subsidy of 1 crore to the producers of good X. So what is the national income at factor cost? The first thing that we are going to notice is that what is the gross value of all the things that have been produced. So for that, we will simply add the final values. The final value of good X was 15 crores and the final value of good Y was 30 crores. If you add them together, that is going to give you the gross value, which is 45 crore rupees. All right. Now, what is the depreciation? In this question, they have not mentioned any value for depreciation. And since they have not mentioned any value of depreciation, we are going to impute the value of depreciation from our end, which is 0. All right, if depreciation is not mentioned, we are going to assume that it is 0. We are going to impute a value 0. All right. So in this case, we are going to find out that the net value is going to be gross value minus depreciation, where the gross value is 45 and the depreciation is 0. So upon subtracting it, we are going to get 45 crores as the net value. All right. But this is the net value at the market price. So we are getting net national product at market price. We are not interested in that. We want net national product at factor cost. In order to make the conversion from market price to factor cost, what do we need to do? We need to subtract. We need to subtract the net indirect taxes. So what exactly is the net indirect tax in this case? The government has taken out 5 crore rupees in the form of GST and they have given in 1 crore rupees. So the government has effectively taken 4 crore rupees, right? The government has effectively removed 4 crore rupees. So 4 crore rupees is going to be the indirect tax, the net indirect tax in this particular case. Now, if I take the market price and from that I subtract 4 crore rupees, that will give me the factor cost. All right. So in this case, the net national product at factor cost is going to come out to be 45 crores minus 4 crores, which is 41 crores. All right. Now, let's have a look at yet another metric that is called the gross domestic product. Now, when we talk about gross domestic product, it can be either at market price or it can be at factor cost. But when we are talking about gross domestic product, without mentioning anything, so we generally assume that we are talking about market prices. All right, that is the metric which is more commonly used by the government of India. Because if you look at any news channel, they always talk about GDP growth rate, and so forth. And all these things are measured in terms of market prices. So if somebody tells you gross domestic product, so you have to make an assumption that they are talking about market prices, unless they specify otherwise. All right. Now, what is GDP at MP? GDP at market price is the gross value of all the goods and commodities that are produced in the country in a year, and they are computed at the market cost. All right. So you can see the distinction right now. In the previous example, in the previous case, NNP at FC, we were talking about the net value. Here we are talking about the gross value. In the previous case, we were talking about the factor cost. Here we are talking about the market prices. So the distinction is very clear. All right. But still, we'll have a look at one example in order to understand it. But a country produces only two goods. This is the same example that we had seen earlier. But in this case, we will try to compute the GDP at market prices. So what is the market price of good X? The final market price of good X, that is 15 crores. What is the final market price of good Y? It is 30 crores. If I add them together, what will it give me? It will give me the market price of all the commodities that have been produced in the country, right? That will give me 45 crores. So simple as that. The gross value at market price is equal to 15 crores plus 30 crore, which is 45 crore. And that is the GDP in this example. Now, apart from these, we have got many other metrics that can be used to measure the income of a country. Those metrics are NNP at MP. NNP at MP means net national product at market price. Apart from that, we have net domestic product at market price. Then we have got net domestic product at factor cost. Then we have got GDP at FC, which is also called gross domestic product at factor cost. Then we have got GNP at MP, which is called gross national product at market price. And lastly, we have GNP at FC, which are called gross national product at factor cost. So we are not going to discuss all of them in detail right now, because we will have many examples in the course of this chapter. We will have to tackle them and we will deal with them one by one. And the basics that will be required to deal with any of these things have already been discussed right now. All right, so let's move to the next topic. But before we move to the next topic, let's address a few common misconceptions that people have about the chapter of national income. If you're going to ask any of your seniors, if you're going to talk to any of your pass outs, they're going to say that this chapter was perhaps the toughest chapter of economics. And why exactly do they say that? They say that because it has got a multitude of formulas that they think needs to be memorized. All right. That is the root cause of the entire trouble. You don't need to memorize the formula. The formula of this chapter are very cohesive in nature. Every formula is related to another formula by a simple logic. All right. So basically, what I'm saying here is that national income chapter has got something more than just formula in it. It has got an underlying logic that needs to be understood first. And if you understand that underlying logic, everything is going to become crystal clear, and learning the formula after that is not going to be that difficult to task. All right. So what is that underlying logic? That underlying logic can be explained by the means of this single diagram. So all the people who have studied the first chapter of macroeconomics must be familiar with this diagram. This diagram represents the circular flow of money in the economy, right? There is some money which is flowing from the household sector to the business sector and back to the household sector. If you can understand this diagram properly, you have understood everything that needs to be understood in order to compute national income. And that will simplify by a very great extent the formulae that need to be memorized or do not need to be memorized. It all depends upon you. All right. So we'll be dealing with this diagram and the methods of computation of national income in the next lecture. Till then, sayonara, adios. Thank you.